Hey, welcome back people. I know it has been extremely happening in China. There's been a lot of recent developments, and more importantly, I'm a retail investor like you. I do not have a team of analysts constantly harping on all the news article and news cycle, digesting all the new information coming my way. But in this video today, I'll just be discussing something that's extremely important, and I believe many investors out there who are invested in China hold this metric very closely to our hearts. I think one of the main investment theses for most of us out here is that we are extremely bullish about China's economic growth. We are able to extrapolate the economic growth from the previous decade or so. We've been seeing China post double-digit GDP growth rate. We are looking at how they're able to lift more and more people out of the poverty cycle. And I believe most of you who are invested in Alibaba do buy into the same thesis. As more and more people get lifted out of poverty, more and more people have more money, they feel more liberated, they'll buy more stuff, and this entire economic cycle, it will just fit into a perpetual loop. And Alibaba is the exact company perfectly positioned to capitalize in this exponential growth. However, for those of you who have been following me for quite some time, you should know that I focus not only in the underlying business, I also look at the macro picture and understanding CCP on a much deeper level. And for those of you who haven't smashed the like button, what are you waiting for? Anyway, if you were to look at the recent 14th five-year plan released by the CCP, we understand that there was this change in focus. Rather than focusing on just driving numbers and just driving the GDP growth, instead, now the government is looking at valuing quality over quantity. And more importantly, the bigger question we should ask ourselves is this really the main agenda of the government, or is this just a smokescreen or a red herring being thrown in by the government to defend themselves in the slowing growth rate? So as investors, I know I've been extremely bullish about China, but we have to remain cognizant and critical. Take every single piece of fact as they come your way with a critical perspective. Don't just believe mainly on what the Western media says, and also don't foolishly trust what the CCP has to say. And fundamentally, whenever we are greeted with new information, please go back and revisit your investment thesis. Has anything changed? So in this video specifically, I would like to address the elephant in the room. I would like to address the slowing down of China's recent GDP growth rate. And for many of you who have been entrenching yourself in all the different news medias, you know that, hey, the macro picture is still that we are still in a pandemic, where they still adopt a zero COVID policy stance. On top of that, we also realized that, hey, recently there was also this power and energy shortage. And last but not least, this entire Evergrande debacle, which is shaking up the bedrock of the financial economy. So just recently, Goldman actually cuts China's growth forecast, citing power crunch as yet another growth shock. So the Wall Street banking giant now expects China economy to grow 7.8% in 2021 compared with a year ago, lower than its previous forecast for an 8.2% year-on-year expansion. For those of you who have been following China, I would believe that this headline wouldn't shock you. So China's third quarter economic growth actually slowed sharply to 4.9%. So China's economy grew 4.9% in the third quarter from a year earlier, slowing sharply from the previous quarter's 7.9% growth rate, as power shortages and supply chain problems added to the impact from Beijing's effort to rein in the real estate and tech sector. I think more importantly, something that we have to distinct is that the reining in of the real estate and tech sector is more of a planned discourse, while the power shortage and supply chain problems isn't really something that the CCP could have controlled. Of course, there are conspiracy theory out there saying that China is intentionally disrupting the entire supply chain problem so as to slow down the growth of the Europe or US or UK's development and recovery. I would just like to reiterate that the Earth do not spin around just one or two economies. By hurting yourself just to bring someone down with you, I don't think that's an extremely smart move to do. And more importantly, I think China has been on the losing end in terms of producing and churning out all these different growth rates. So if you were to look at it, the power shortage and supply chain issues are actually exacerbating the problems. Of course, when you're trying to rein in the different sectors to ensure that all these different companies and in these specific industries are playing by the rules, you definitely hope that the entire system is continuously functioning. But ultimately, as Murphy's Law states, what can go wrong will probably go wrong. Now, the slower than expected GDP growth reflects a range of factors, including policymakers' decision to par back stimulus enacted, a crackdown on the tech, private education and real estate sector, energy snafu caused in part by soaring coal prices and disruptions to the supply chain caused by the COVID-19 outbreak, semiconductor shortages and port shutdowns. So despite the third quarter slowdown, economists are generally confident that the Chinese economy will be able to make a senior leader's annual GDP target of 6% or more. So funny enough, the senior leaders of China actually only have a GDP growth target of 6%, while Goldman on the other hand, after the cutting of the forecast, still maintain an extremely bullish outlook of minimally growing at 7.8% in 2021. Now, a spokesman of the Statistics Bureau highlighted the economy's ability to maintain its post-pandemic rebound in the first 9 months of the year, even in the face of what he describes as the country's carrying forward its structural adjustments with reference to the government's campaign to deal with debt and inequality. And I'd just like to take the time to remind you guys that, hey, in 2020, when the pandemic was raging on, everybody is trying to adapt to this new normal and trying to find new ways to try to boost their GDP growth. Every single major economy out there suffered a negative GDP growth rate in 2020 alone. However, China is the only major economy that continued growing at 2.3%. So for those of you who think that, hey, power shortage, tech crackdown, chip shortages, and all those nasty stuff is going to slow China down, think again. I think when COVID-19 can't even slow down the growth of this country, it takes a much bigger force in order for us to be extremely disappointed in China's growth. And more importantly, like the spokesman said, they are essentially carrying forward its structural adjustments. So essentially speaking, the government is trying to draw the line, and they think that it's a good opportunity to try to get everybody back on the same page. Now, Mr. Fu said that there are increasing uncertainty in the external environment, while the domestic economic recovery is unstable and unbalanced. So Beijing policymakers instead set a relatively modest full-year GDP target of 6% or more for 2021, giving it more room to deal with the long-festering issues in the economy, chief among those dizzy debt levels. So on Friday, China's central bank officials suggested it wouldn't resort to a relatively large stimulus to drive up the growth rate in the final quarter of the year. For example, by flooding the financial system with liquidity or slashing benchmark interest rate. Funny enough, I think this commentary is just them trying to take a jab at their fellow major economies. So Monday's data release also showed that though the country's headline jobless number dropped and domestic consumption recovered somewhat after a difficult summer, industrial output, a measure of the factory's production, rose just 3.1% in September from a year earlier, slowing down from the August 5.3% year-on-year growth, and falling short of the economy's expectation of a 3.8% expansion. And I think why is it important for us to focus on this industrial output growth rate? Because ultimately we know that CCB currently has a new focus in trying to transit back into their dual circulation strategy and focus a lot more in terms of hard economy. And manufacturing and industrial happens to be part of this hard economy because it produced tangible results rather than a virtual economy. Now, on the plus side, retail sales, a key gauge of domestic consumption, rose 4.4% in September from a year earlier, rebounding from August's lackluster 2.5% year-over-year increase, and topping the 3.4% rate expected by economists. So the silver lining is, as pointed out, I think unemployment rate has been steadily dropping, more and more people are getting employed, but yet at the same time, a lot of all these key sectors and key metrics or key benchmark that the government is looking out for isn't really exactly going in tandem with their expectations. But luckily for us, for those of you who do have vested interest in Alibaba, retail sales and domestic consumption is growing in tandem with expectations. So generally speaking, there shouldn't be a huge disparity in terms of our expectation and reality. Now, domestic consumption took a hit over the summer after fresh waves of the new virus and infection prompted authorities to restrict people's movement in some parts of the country, dampening consumer demand. Now, to go to the good stuff, many of you are not interested about China's growth, you just want to know Alibaba's growth, right? So essentially, Alibaba's earning forecast was actually slashed on week's consumer spending. So the company is expected to report their earnings on November 5th, a week before China's busiest online shopping festival, which is Singles Day. And analysts have actually lowered their consensus 12-month earning projection by nearly 5% over the past 3 weeks. And right now, the forecasted EPS sits at around $1.96. So if you were to look back at Alibaba's EPS trend, the same quarter last year, Alibaba actually reported $1.54 compared to the current forecasted $1.96. Essentially, if you were to ask me for my own opinion, I would think that they will easily beat $2 earnings per share this time around. Even despite being plagued by so many problems, headline jobless data actually trended downwards. Domestic retail consumption has been beating expectations, and even though there were a lot of problems surrounding supply chain and even the power shortages, I think generally speaking, Alibaba was still quite resilient to all these manifested problems. I think the biggest thing that would actually affect the numbers of Alibaba would be this entire Evergrande problem, and not because of the slowing down of the GDP. Essentially, speaking from experience, I think the Chinese people really love their properties a lot, and a majority of their net worth is actually locked up in their property holdings. And because of how this entire Evergrande thing has played out, it has altered the mindset of many normal Chinese consumers. When you see that there's a very big reduction in your net worth, even though it's just a paper figure, people might be less inclined and less obliged to be spending money. And we definitely have to take the following 2 or 3 quarters to really evaluate how big this entire impact in terms of both the expectation and the actual consequence of the change in domestic consumption patterns. But I think the silver lining is the entire macro perspective looking down on China right now, they still focus on domestic consumption. They have a zero COVID tolerance policy. So whenever people wishes to travel overseas, whenever they come back, they have to go through strict quarantine orders. They will have to make sure that they abide by all these different regulations and rules put in place, which also deterred a lot of people from spending overseas. So essentially speaking, a lot of all this wealth generated internally will be circulated back into the economy. And it is definitely in line with what the government wishes to achieve for its own country. And more importantly, please spread more common prosperity in China. We need more commoners lifted out and pump the entire economy. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!